Hey everybody, welcome to another live stream. Make sure you comment so I can add your name to the list. We do 2 raffles. You could win a $20 Amazon gift card. What a terrible week, right? God, I can't even look at my portfolio. It makes you, when a week is this bad, it makes you feel like you don't know anything about investing. Feel like you made the worst investments. But as long as everybody's down, it's okay. It rebounds eventually. It's just painful dealing and seeing the downside. Up 23% on Dow. Wow. Yeah, Blue Knight got bought out. Were you the one who kept talking about Blue Knight? That was a good idea. Yeah, I guess if you're invested in anything oil related, it's probably okay. Dow Dow Industrial, right? Netflix. Yeah, God, what a bad idea. Netflix. I feel like an idiot. When it fell 50% a couple months ago, I thought it was a steal. But this is just what you have to go through, I guess. Go woke, go broke. Yeah, I need to start making money so I can add it, so I can buy when it's low. That's my only regret, but hopefully it doesn't take that long, because in March 2020, it was so fast. It was like a month, right? And the market started coming back. The Great Recession in 2008, that took a little longer. I think that took at least a year, maybe even longer to rebound. We're gonna talk about leasing. I put together information on leasing. It's a bit confusing. It's not going to be straightforward, and I don't really have any examples either, because I was just trying to piece it together where I could kind of explain it. And it's helpful too, because I forget like the type of leases and how they work. So it's good for me to like put this together and talk about it, because then hopefully I'll remember it better. M. Taylor. Is anybody familiar with lease accounting? So I work at Walmart Distribution, and my DC is going to automation by Symbiotic, and they are spacing my with Matthew Summer, Christian stocks with no revenue. Yeah, it was a bad day, right? Didn't it go down 1,000 points on Friday? One of the worst days. I don't look at the market overall. like I don't look at like the S&P, how it did for the day. I look at stocks that went up and like what went up the most, went down the most. But besides that, I don't follow it that closely. I spend most of my time doing videos, so I don't even have time to follow it. Matt here. Yeah, make sure you comment. I'm gonna do the raffle soon. Oh, I did. I'm gonna do MPLX tomorrow. I spell it wrong. MPLX tomorrow. Today I did Kinder Morgan. I did Kinder Morgan today. That's a popular midstream stock. There's on my videos, I usually compare like the price chart of the stock I'm doing, which was Kinder Morgan, and I compared it to other midstream companies like Enbridge, Enterprise, and I did compare it to ET. And ET did the worst by far. Like in the past 5 years, it's down like 30%. Well, maybe 20%. But the others are not really down much at all. And I think Enbridge might have been up. Why is everybody freaking out about bonds? Wouldn't right now be a good time to be buying bonds? I don't know if it's a good time to buy bonds. Why? Because interest rates are going up. If you have a 4% bond and you say you buy a $10,000 4% bond, and then next year interest rates are 6%. Your bond lost a lot of value. Your bond is probably worth $8,000. So probably lost like 20% value. I'm just throwing out numbers. So as interest rates go up, bond prices go down. Maybe if you bought adjustable rate bond, that's okay. If rates are really high and you could lock in a high, because I remember, I don't remember, but I remember somebody telling me, I think it was in the 80s, rates were like to get a mortgage, it was like 13% on your home. Somebody was telling me that she got bonds at like 18% interest rate. That's what they were trading at, like 20-year bonds. Or could you imagine getting a bond at that high of a rate? CB 350. C348. Trend. Evan. Matt. Amazing playthroughs. Investing education. Do people just log in and put their names and leave? Because now there's only 15 people in the chat. But when you sell the bond, you get your principal back, don't you? Yes, you do get your principal back. That is accurate. But if you're locked in at like I said, if you're locked in at 4%, if you just waited a couple of months, you could have locked in the same exact bond at 6%. So it's I mean, you always get your principal unless the bond defaults, but assuming that doesn't happen, Ed Yee. Right. When I say the value of the bond, like if you got a $1,000 4% bond, and then say it was a 1-year bond, and say next month the 1-year bonds were trading at 6%. Then your bond, you can't sell it for $1,000. You could sell it for, it's only worth like 800 because no one's going to pay $1,000 at a 4%. They could just pay $1,000 6%. You have to, in order to compensate them for the lower interest rate, you have to sell the bond for cheaper. But right, you don't have to sell the bond exactly, but you're still going to be collecting that lower interest. Okay, let's one, JB Weld. 4, Christian. I mean, you could always find really high risk, high yield bonds for like 9-10% interest. Yeah, exactly what Matthew said. I mean, you don't know where rates are going to go. The same thing with buying a dividend paying stock. The stock price could go down. I mean, but you don't know that. So let's. I don't think you could say now is a good time to buy bonds. Maybe you could, but either you want to buy bonds or you don't want to buy bonds. The rates are the rates that they're currently at. You can't really time. I don't know if you can't really like time interest rates and say I'm gonna wait for interest rates to rise so I can start buying bonds. That's probably hard to do. Yeah, I think REITs would be good. You mean for interest rates? I think pretty much buying most stocks is a good hedge for interest rates. 3, buying anything besides leaving the money in your bank account. Well, not buying anything. Buying a car is not a good inflation hedge or interest rate hedge. 16. Reverse stock split. If it falls below $1, then it might reverse split. 12. CB 350. So CB 350. If the market panics, a lot of people do buy the treasuries for safety. Yeah, I mean, especially if you're getting close to retirement, some people feel comfortable with bonds, or I mean, treasury bonds, really, it's kind of like, what is it like? 0.5% interest. There's nothing to invest that's going to beat inflation right now. Does anybody invest in it's TIPS, Treasury Inflation Protected Securities? Does anybody invest in those? Are those good? Because my friend invested in them, and he said they're not going up. Like, he thought they would be going up a lot with inflation, but they're not. Is anybody getting killed on Netflix like me? I feel like I'm the worst investor when I see like that I invested in Netflix and Facebook. So if you have tips, then is it going up now with inflation? I'm like, I should have just kept it simple. I should have just kept with the S&P 500 and not try to get fancy with these other stocks. That's what happens. It's hard to even beat the S&P 500. I don't even know why we try to like just put your money into SPYs and just relax. The only thing that's doing well is Energy Transfer. Everything else is going down. I mean, I'm still up overall on a lot of stocks, but they've come down a lot. This is going to be not the most straightforward discussion like in prior weeks. And I think I put it together in a way which I think it makes it'll, at least I understand it, but let's see if it makes. So when a company wants to buy an asset, like a building, or if they wanted to buy a piece of equipment, like maybe like a tractor or even a car. So when we buy an asset, we generally we either use cash. We take cash out of the bank. Say we want to buy a car for $30K. We'll take cash out of the bank and buy the car, or maybe we'll get a loan. So we'll have an asset that's valuable, but we'll also have debt that we have to pay on that asset. It's positive. So there's different ways to do it. Alternatively, instead of buying an asset or taking a loan, you can just lease an asset. And a lot of companies lease assets. You might have seen on the when I do my videos, like the right of use assets. When you see right of use, it just means they're leasing it from another company. And so to simplify it, the way it works is a company, and you could think of any company, Energy Transfer, and they're the lessee. So when I use the term lessee, that means the company receiving the asset. They purchased the right to use an asset from another company, the lessor. And it could be a few months, or it could be 10, 15 years, whatever the terms are. I'm sure some people here might have leased cars before. And then it's the same way as if you leased a car. Yeah, I don't think Netflix is going away. I'm not too concerned. I'm just a little annoyed that I bought it. It's going down, but you always get upset when your stocks go down. So the lessee, the person receiving the asset, just makes periodic payments to the lessor, either monthly or annually. So, I mean, the advantages of leasing, it's usually less costly. Because if you buy an asset outright, or you take a loan to buy an asset, it's going to probably cost you more money than leasing it. Leasing it is just kind of like borrowing it for a certain amount of time and then giving it back. It's less restrictive than a loan, because a loan, there's a lot of clauses in the loan, especially if you're not a big business and you're leasing a large asset, like an expensive asset, like an entire building. So there might be within the contract, it may say you're not allowed to purchase or lease any other buildings until you complete the lease with us. So there might be a lot of restrictions. Or maybe you can't issue any preferred equity, because they don't want, if somebody's given a building to you to lease, which is an expensive asset, they want to make sure you're going to be creditworthy and pay them back. Netflix needs to spend more money for creating quality content. Well, they did mention they're going to try to charge, I don't know how, but charge people who are sharing passwords. And then they may have another option for Netflix where it's going to be cheaper, the monthly rate, but you're going to get commercials. They spent $300 million on new seasons. And another benefit to leasing is there's less risk of obsolescence. So if you bought something, like a piece of machinery, if after a couple of years there's a newer, better model, you're kind of stuck with it unless you're willing to sell that machine and get the new one. Because when you lease it, you just give it back at the end, and then you lease something else. You'll lease maybe the newer model. My flip flagged me because we had 2 people sharing my password. Disability's already. Oh, that's interesting. Okay. So that's the high level of leasing. So we're going to talk about the lessee, how the lessee reports the asset on their balance sheet, the leased asset. And then we're going to talk about the lessor, how they report on their financials. I see that these big names like Vanguard and BlackRock, they own thousands of shares of AGNC and they are not selling them. My question is why people are not saying that people who own AGNC was testing the no sharing of password thing in South American countries. I don't know. It's hard to look at these big funds because they have so much. There's so much capital, and I don't know. I'd have to look into that more, but okay. So the lessee, the company that's receiving the asset, the company that's paying the lessor to use the asset. Okay. So there's 2 ways the lessee can carry that asset on its books. They either call it a finance lease or an operating lease. I hope someone's listening. No one's even said anything yet about this, and let me know if you have questions. So they would call it a finance lease. You might see capital lease, same thing. The finance lease, it's kind of like, think about financing a car or leasing a car. With a finance lease, the benefits and risks are transferred to the lessee. So think of it like a building. If I entered into a finance lease to receive a building, that means it's my responsibility. So I have to maintain the building. If something goes wrong, something breaks, I have to just a lot of the risk is on me. Where an operating lease, maybe there's less, I need to do less. Like if something goes wrong, something breaks inside, or the roof caves in, the person I leased it from may have to be responsible for fixing those stuff up. And generally, when you sign a finance lease, like at the end of the term, you can usually keep the asset or pay for the asset to own it. There's usually that option at the end of the lease. Like financing a car. The idea when you finance a car is that it's kind of like your car. And at the end of the term, you keep the car. Where if you did a traditional lease, you just pay like maybe 3 years to use the car, and then you give it back to the company. Am I using that term right? If you finance a car, if you finance a car or lease a car, I think that makes sense. Who here is buying Nike? Okay, so the way the lessee reports a finance lease on a balance sheet, they have to figure out the lease. They have to look at all the lease payments into the future. Say it's a 5-year lease. Say they have to look at all 5 years of those lease payments. Just say it's like $10K a month for 5 years to use that building. Or you can call it a warehouse, whatever you want to. So we'd have to present value those 5 years back to today. So say it's like it's $400,000. That's how much I would have to pay present value in today's terms. So it would be more than $400,000 because some of those payments will be years from now. So if that's the present value of $400K, present value of the future lease payments. So the lessee, I have to report that on my balance sheet as an asset and liability. Because when you lease something, it's for accounting purposes, it's pretty much the same as you owning it. It looks the same as if you owned it. And it's not that wildly different between taking on debt and buying something and leasing it. There's a lot of similarities. So you put $400,000 in your asset section and $400,000 in your liability section, because you have that building, that's an asset. So that's why it goes in the asset section, and then you have $400,000 in your liability section because you owe the lessor all those monthly payments. And then you depreciate the asset over the term of the lease, and usually do straight line. That's the most common. So the value of the so 400,000, and we're going to pretend it's a 5-year lease, right? $6,000. So every month, or I guess you do quarterly, you report quarterly. So every quarter, you deduct $20,000. So in the first quarter after leasing this asset, you report on your asset section, you report 380,000. Next quarter, 360,000. And then 340 until it's zero. So, and you're paying principal and interest payments to the company that owns the building. So all the interest payments. So say the first month, it's like 5,000 principal plus 1,667 of interest. That's the first payment. The last payment will probably be something like $500 of principal and 6,167 of interest. Because in the beginning, you're mostly paying. Wait, did I wrong? Did I wrong? Okay. Okay. I'm just making numbers up, but so in the first. Let me flip that. In the first payment, it's mostly interest. You don't pay that much principal on the first payment. Maybe this is more accurate. Okay, so the first payment, you're paying mostly interest. So you pay every payment the same amount, 6,667. So the first payment is mostly interest, 6,000 interest, 667 of principal, very little principal. But then as the principal balance gets lower, you pay more and more principal each payment. So maybe the last payment would be only $667 of interest, and the rest is principal. Yeah, drink beer instead of taking notes. But anyways, the interest portion of the payment, it goes straight to your income statement. It as interest expense. And the principal portion of the payment. So in the first payment, you would see 6,000 of interest on the income statement, and the loan and the principal balance would get reduced $667. So you reduce the principal balance on the balance sheet, the principal amount. So the depreciation schedule will be different than a principal and interest schedule. So that's why when you look at usually at any point in time, they're different. Like you may see the lease liability, it says 10 million. And then when you look at the asset section, the right of use asset is like 9.5 million. at the end of the lease term, after the 5 years, they both equal 0. But they're different at any given time. This is hard to explain, but and also the interest portion of the lease payment will appear on the statement of cash flows in the operating section. Nice. I appreciate that. So you'll see the interest portion on the cash flow from operations section. It's a cash outflow because your money's leaving the company. And the principal portion of the lease payment is in the financing section. Financing, not financial. Okay, so that's a finance lease for the lessee, the person who has to pay the loan. If they recorded the loan or the lease as an operating lease, then everything's the same. The only difference is the entire lease payment, the principal and interest lease payment, that entire amount is reported on the income statement. With a finance lease, only the interest portion is reported on the income statement. With an operating lease, the entire principal and interest, but everything else is identical. The principal portion of the payment still reduces the balance sheet, the asset on the balance sheet. But sometimes if you look at the way companies record leases, it will have an effect on. Do you focus on value or growth? Value. Definitely value, but I tried on value. Okay, so if anyone has questions on the lessee portion of this is actually more straightforward than the lessor. Okay, so the lessor, the entity that's giving the asset to somebody, the one that's receiving money, they can record the lease as a sales type lease. I know we've seen all these terms in the videos I've done. A direct financing lease or an operating lease. Those are the 3 options. It's 6. Did I miss anybody? Is anybody? 5. 18. Buster. Keaton. Okay. What's the question? Now I'm adding you to the raffle. 4. Kahlua. Okay. Five. Okay. It's over. Joe S1. Joe Schneider. Okay. Okay, so Lessor. So see, both companies have to record the lease on their financial statements. Okay. So Lessor. So if they record it as a sales type lease, it's kind of like the finance lease for the lessee. And the way you can identify if it's a finance lease is if the lessor transfers ownership to the lessee. Yeah, make sure you email me, Joe, to claim your raffle. Okay. I'm losing people. Sorry, this is not too much fun, but okay. I guess this is for me because this helps me to remember this stuff. So like if you write into the lease contract at the end of the 5 years, the lessee can buy the asset at the end of 5 years. It would probably be a sales type lease. Efren, what's up? Okay. So this is how the lessor records this lease payment on their financials. Okay. So on the income statement, they record because they're going to be receiving principal and interest payments from the lessee, right? So the interest portion of the lease payment, let's just say $3,000 principal plus $8,000 interest, just making up numbers. So the interest portion, $8,000, say that was a quarterly. They would record that as revenue on the income statement. And they would record the net book value of the leased asset, which probably would equal the principal payment, but it might not due to depreciation. So the net book value, do you know what net book value is? It's just the asset that's on the balance sheet, the amount that's reported on the balance sheet minus the amount that's reported on the liability section. So say at the end of the quarter, the asset is carried at $400,000 and the liability is $380,000. So then they would report a $20,000 in cost of goods sold. That's as an expense. And then on the balance sheet, see, before they leased the building, they own, it was on their balance sheet. It was an asset on their balance sheet. So they have to de-recognize the asset, like remove it as if they own it, and then post a, I mean, they're just kind of like, say it was 1 million when they first leased it, and it was on their balance sheet as an asset for $1 million. They would just remove that asset because it would probably be in the in the non-current asset section under PP&E, property, plant, and equipment, that building. So they would take it out of that section and then recognize a lease receivable. So then it would be a receivable on a balance sheet. Like, I don't know what it would say. The confusing thing is each company kind of does their own thing. Like they label things differently, which makes it confusing. So you might see lease receivable in the asset section, or maybe loan receivable or something receivable. But anyways, it wouldn't change. It would still be in your asset section, just labeled differently. And then on a cash flow statement, the principal portion of the lease payments they receive is an inflow in cash flow from operations. If this company's primary operations is leasing assets. So like if the company, that's their business, right? Some companies, they buy equipment and they buy different products and they lease them to different companies, and that's just what they do as their business. If that's their business, it would be a CFO. There would be an inflow of cash in the cash flow from operations section. But if it was just a company, we could pick Energy Transfer. Energy Transfer is an oil and gas company. If they just had an extra warehouse that they weren't using anymore for whatever reason, and somebody else, another oil and gas company, needed a location there, Energy Transfer may say, okay, we'll lease it to you because we're not using it anymore. So in that case, they would report it as an investing in the CFI, cash flow from investing section. Just the principal portion, it would be in the investing section. And the interest portion of lease payment would always go into CFO, regardless of what the company did. I get confused too when I look at, and I can't really, but this is going to help me explain it better while I'm doing videos, because I always see sales type lease and I try to explain it, but now I think I'll be able to explain it better. And it's funny because the first few times I talk about a topic, like I don't think I'm explaining it that well, but the more I do it, kind of like a comedian, when I keep doing the set over and over, they kind of tighten things up. That's how I feel. Okay, so if the lessor, they could record the lease as a direct financing lease, and that means that's probably like an operating lease right here. That means at the end of the lease term, the lessor is keeping the asset. They're not transferring it over. But in order to qualify as a direct financing lease, all three of these things have to happen. There's no transfer of ownership to lessee at the end of the lease term. A third party guarantees the residual value of the asset at the end of the lease term. So I guess you could think of like an insurance company, maybe, guaranteeing the value at the end of the term. And the third thing that has to happen to be a direct financing lease is the sum of the lease payments and residual value is greater than or equal to the fair value of the asset. And just fair value just means So say does anybody need me to embellish on that one? The sum of the lease payments and residual value is greater than or equal to the fair value. When a company issues shares, it's kind of like a grocery store putting a new product on the shelf, or is every share accounted for? Usually when a company becomes public, they'll and you can find this in the on the 10K or all those reports, like how many shares they could issue. So they may say they may say 10 billion shares they can issue, up to 10 billion. So they may, I mean, that's too high. Let's go with 3 billion. They could issue 3 billion shares, but when they first IPO, they just sell 1 billion shares into the open market. And if they need money, they can keep issuing shares, like say 100 million every year for the first 5 years. So usually in the documents, it'll say the maximum number of shares they can issue. Is that what you mean? When a company issues shares, it's kind of like a grocery shop. Yeah. So if they say they can issue a maximum of 3 billion, and say they IPO 1 billion. Yeah, they're all out there, all 1 billion. That's what we have to use to calculate like the earnings per share number. We use 1 billion. The only way that changes, the 1 billion changes, the company issues more shares, which companies do all the time to raise money, or they buy back stock, which some companies do a lot of too, if they have cash. So you might see one quarter 1 billion shares outstanding, then the next quarter 950 million. Well, I guess yes. Somebody owns the shares. There is an owner. Because when a company IPOs and they issue 1 billion shares, they're not actually selling 1 billion shares. They're giving them to an investment bank. So JP Morgan and Goldman may be the underwriters. They always have underwriters. So JP Morgan and Goldman, they both buy 500 million shares. A company X.com IPO'd, and JP Morgan and Goldman said they value the stock and they come up with $10 a share. The company and Goldman and JP Morgan, they figure, okay, $10 seems appropriate for the company. So JP Morgan gives the company $5 billion, writes them a check. Here's $5 billion. Goldman Sachs writes a check, $5 billion. Now Goldman and JP Morgan are on the hook. They want to sell those shares into the open market as soon as the company goes public. They usually do, I think. So it's really, so they own the shares. Even if the worst case scenario, nobody wants to buy the stock, then they own it. Somebody does own it. But the goal is for JP Morgan and Goldman to just keep selling the shares into the market, so they're off the hook, and hopefully they make a profit. And underwriters make a lot of money for doing this. They get a pretty big fee. Exactly. Companies, they're not in a business to, um, say Energy Transfer wants to go public. They're not in the business to sell stock in the open market. Like, they would have no idea. They know how to transport gas through pipelines. They know that. They know how to store gas. They know how to maybe even extract gas, which they don't do. They're a midstream company. They don't know the equity markets. Most companies don't know the equity markets, unless I guess JP Morgan goes public as a company. Maybe they'll sell their own shares. But yeah, of course, the company doesn't do that stuff. It's the investment banks that handle all the um, anything with the financial, the, of the stock market. Where were we? Okay, so I know somebody said nobody cares about these. I know people just want to know how to make money. Some people do care about it, but it just helps me to. Um, but if we should talk about this deeper, because I do want to. Um, there's things called market makers, because in order to build a to get the shares out there in the market and to get like people to buy the stock, there are people who, I think the term is market makers. But I'll put that together maybe for the next stream. Like kind of like the pieces of the process to IPO. Because I mean, it's kind of like choppy in my head trying to explain it. I'd have to kind of refresh my memory on a lot of things. But anyways, so say Energy Transfer leases a building to Kinder Morgan because they had that building, and so this third term, the sum of the lease payments. So say the sum of the lease payments is $1 billion, and the residual value. It's probably not a good idea to do a building because then sometimes it appreciates in value. Let's just pretend Energy Transfer is selling like this really complex piece of machinery for $100 million. 5 years. And at the end of 5 years, they estimate, there's wear and tear, that the asset will be worth $20 million. So that, which is $120 million. So if in the open market, if that piece of machinery can be sold, if they can sell that piece of machinery for $90 million in the open market, then it would not qualify for a direct financing lease. It would have to be if the machine was worth $150 million in the open market, then it would qualify on this third term. Yeah, I shouldn't have been so aggressive. On like my first week there, I was telling them all the things they needed to do, and that I can easily streamline everything. I should have just kept them to myself. I'm too kind of in that mindset of like running my business and like being the boss. I don't think people like that. Even if I'm right, and maybe in their mind, I didn't understand it as that well. Okay, so if it qualifies as a direct financing lease, then they have to report it on the income statement. Just the interest portion of the lease payments is reported as revenue. So that'll boost the company's revenue. And the same thing with the balance sheet as earlier. They have to de-recognize the asset that they had before, and then recognize a receivable, because now I was retired, but I got so bored at home. It got kind of boring after like 3-4 months. But anyways, I have actually a few things on horizon, so I don't really care that much. And on the cash flow statement, it's exactly like the sales type lease. So the principal portion is reported as cash flow from operations. If that's what the company does, that's its main business, is leasing assets. If it's not a leasing company, then it's in the investing section. And you should stop playing video games. I don't know. I'm not into video games. After middle school, I don't find that much interest in it. Okay, but now I'm doing 2 videos a day, so now I'm busy. It's not so much about like, part of it is being bored, but it's just like not having any contact with the outside world. I kind of feel. And then if the lease doesn't qualify as a sales type lease or direct financing lease, then by default they have to record it as an operating lease. If these two don't apply, and then the way that's recorded on the income statement, I got to double check this. The lease payments they receive are, oh no, this makes sense. The principal and interest on the lease payments is recorded as revenue, and the depreciation that is an expense, because you have to depreciate the asset, whether you're the lessee or lessor. I'm pretty sure this is accurate, but I'm not super comfortable, as you can see. I mean, I think the high level idea of it I could say, but when I try to explain the details, it gets a little confusing. Okay, on a balance sheet, it stays as a leased asset. You don't have to de-recognize it. Exactly. Nobody wants to hear someone tell them how to do things. It's obnoxious, and I shouldn't have. I did tell them. I said, this is just how I see things, but I said I'm going to need a few months to understand, because I'm sure there's things I don't know yet about the job, but so far I think I can add a lot of value if I link up a lot of these Excel files together. But I said I'm not going to be changing anything for a few months because I do need to learn things better. But just the way I see, yeah, I probably wouldn't have said that. But when he hired me, he said, I have a lot of things I want to do. I want to, and I haven't been able to do it because I'm so busy. So I thought he wanted me to do these things. I thought that's why he hired me, but anyway, whatever. And on the statement of cash flows, the entire lease payment is a operating inflow. I mean, technically, I wasn't fired because it was a temp agency. I didn't work at that company. The temp agency found me and convinced him, because he didn't even want to talk to me initially. He thought I was too overqualified. And then I said, I just want to get out of the house. I didn't say that, but I said, I want to, add value somewhere and do something. And it's right near my house. Like, it was so close, like 5-minute drive. So that's why. So just a few notes on leasing. Just understanding the high level of this stuff. You don't have to understand all this detail because it gets confusing. But just understanding the high level. So when an asset is leased, it looks identical to as if the company purchased the asset, like took on debt, like a loan, and purchased the asset. It's pretty much identical. Yeah, I'm not a big fan of cannabis stocks. I don't see the upside, but I think you might get lucky if you time it right. I know at one point they were going up a lot when Biden got elected. And you might see the term right of use asset. That's what it means when someone's leasing an asset. They have the right to use the asset. It's technically, they don't technically own it, since they're leasing it. And also, leases are not considered debt, so they should not be part of the company's total debt. But you might see companies reporting leases as debt, which makes it confusing. But I think technically they shouldn't be. But you look at 10 companies and then they're all doing different things. Like they label things differently. Even labeling differently makes like as simple as like long-term assets. One company says long-term assets, another says non-current assets. I mean, that's not like a big deal, but it gets confusing when there's all these different terms and you don't know what you're looking at. I mean, that's a pretty basic one, but you may see even more where, like I said, a company may put leases in as part of their debt while another company doesn't. It makes it a little hard to compare companies. Well, you're up 20%. That's good. I'm thinking of buying puts on Facebook to protect my downside again, because I don't think I could take another hit on Facebook. I was thinking about buying puts on Apple. I don't know why, but I feel like after Netflix, we're going to see some really. Puts an Apple. Yeah. And I'm gonna kick myself if I get it right and I don't do it. But I'm gonna feel like an idiot burning like $10,000 on trying to short Apple and Facebook. You're right, Netflix. But I just feel like after so many stocks are just doing poorly, like Facebook went down a ton, Netflix went down a ton. Apple hasn't really gone down much. I feel like I don't know. It's probably a bad move. Thank you, JB. Appreciate it. A due diligence course. Yeah, maybe I should do that. I don't know. I don't even know. It seems like so much work to do those things. I don't even know how to get started. So these are the videos I've done. Apple and Microsoft are carrying the market. Yeah, Apple, Microsoft. That's why I think usually things go down together. They're done growing. Okay, okay, DD is coming out tomorrow. IBM and Kinder Morgan. I think I should just do one video a day because it seems like when I used to do one, I get more views than doing two, even the two combined. Like some of these videos get hardly any views. Yeah, we should just be buying index funds and not trying to figure things out. Alex, what's up? Okay, I'm gonna get off now. Thanks for coming. And I'll see you next Saturday. Try to watch the videos and comment. I'll see you next Saturday.